You want to invest in the stock market, but don't know anything about trading? ETFs are a good way. In this video, we will first explore what are ETFs, their intrinsic values and drawbacks, and at the end of the video, we will compare various ETFs to help you make more informed decisions and align your ETF choices with your overall investment strategy and risk tolerance. First, what are ETFs? ETFs, or exchange-traded funds, are a class of investment funds. Much like stocks, they're traded on major exchanges. An analogy might be seeing them as a basket, a collection of assets, be it stocks, bonds, or commodities. They are proposed by various issuers such as BlackRock, Vanguard, Schwab, and Slate Street Global Advisors for the most famous. There are different types of ETFs. They can be classified depending on the asset type, stocks, bonds, real estate, currencies, or commodities, for example, or depending on the market location, US, entire world, Asia Pacific, Latin America, or depending on company's size, large caps, mid caps, small caps, or depending on sector, such as energy or healthcare, for example, or depending on whether they represent a physical or a synthetic replication of the assets they include. Let me explain. In the case of physical replication, when you buy the ETF, you do buy, for example, the stocks included in it, while in the case of synthetic replication, you do not. The ETF only tries to mimic as closely as possible the value of the stocks included in it. Or they can also be classified depending on whether they are based on growth or on dividends. Let me explain. Companies might decide to keep their profit to further develop and expand, or they might pay part of their profit as dividends to their shareholders. Let's explore the advantages of ETFs. When you buy an ETF, you basically buy a whole lot of assets. Of course, this has several advantages. Diversification. With a single purchase, you can have exposure to a plethora of assets. Flexibility. ETFs can be sold or bought anytime during trading hours. Cost effectiveness. Generally, ETFs have low expense ratios below 0.1% and are much lower than traditional mutual funds. It's easy and fast to implement. You basically have no research to do to know what to buy. Hence, it is very little work, and even if you know nothing about stock exchange, it's really straightforward. Dividend yields. Many ETFs offer attractive dividend yields. This is great if you want to live from your investment, but on the other hand, you should keep in mind that a dividend is money which is not reinvested to grow the business. However, it's not all rosy. Let's now see the downside of ETFs. Some challenges of ETFs include liquidity issues. Not all ETFs are highly traded. This might be a problem if you need money and want to sell quickly. Tracking errors. Sometimes the synthetic replication ETFs might not precisely mimic the indexes they track. Minimum investment. Certain ETFs require a minimum amount to be invested. Based on this, let's see the criteria you should consider before buying. Before plunging into the ETF market, it's pivotal to evaluate several factors to ensure a sound investment decision. Objective. Begin by understanding the core goal of the ETF. Is it growth-oriented, value-driven, or focused on income generation? Market cap. The total market value of an ETF provides insights into its size and stability. Larger market caps often imply more stability, albeit with potentially lower growth prospects. Performance. Historical performance, while not an indicator of future results, offers insights into the ETF's track record in various market conditions. Composition. Scrutinize the assets within the ETF. A diverse composition can mitigate risks associated with any single asset class. Concentration. Ensure that the ETF isn't overly reliant on a few assets. High concentration can lead to increased volatility. Turnover. A high turnover rate can indicate frequent changes in the ETF shares, potentially leading to higher costs, while a low turnover might suggest a more stable buy and hold strategy. Max drawdown. This measures the largest single drop from peak to bottom in the value of a portfolio. A lower max drawdown can suggest lesser volatility and risk. Dividend. Examine the ETF's dividend yield and history. A consistent dividend payout might indicate a stable set of underlying assets. Expense ratio. This represents the annual fee that all ETFs charge their shareholders. It's crucial as it does impact net returns. It should be checked in light of the performance. For example, an ETF with a higher expense ratio but a high performance might be more valuable than one with a lower expense ratio but also a lower performance. Liquidity. Ensure the ETF trades sufficiently, facilitating smooth entry and exit points. With these criteria in mind, we will now examine different types of ETFs from the main issuers to help you select the best ones for you, depending on your objectives and investor profile. We will first compare 3 ETFs tracking the total U.S. market. 1. The Vanguard Total Stock Market ETF, or VTI. It is an exchange-traded fund offered by Vanguard that aims to track the performance of the CRSP U.S. Total Market Index. This index encompasses the entire U.S. stock market, including thousands of stocks from companies of all sizes and sectors. 2. The iShares Core S&P Total U.S. Stock Market ETF, which is traded under the ticker symbol ITOT. This ETF aims to provide investors with broad exposure to the entire U.S. stock market, including large, mid, small, and micro-cap stocks, listed on the NYSE and NASDAQ stock exchanges. It is issued by BlackRock. 3. The Schwab U.S. Broad Market ETF. With the ticker symbol SCHB, this ETF aims to track the performance of the total U.S. stock market by tracking the Dow Jones U.S. Broad Stock Market Index, providing investors with broad exposure to U.S. stocks. It is issued by Schwab. Here is a comparison of the performance of these ETFs in the last 10 years using the site portfoliovisualizer.com. Actually, all 3 graphs are overlapping, and if you had invested $10,000 in 2013 and reinvested the dividends, you would now have roughly $37,000 with all 3 ETFs. This corresponds to an average annual growth of about 13%. The max drawdown in all 3 cases is about minus 24%. Let's now compare in detail the main criteria we discussed earlier for each of these 3 ETFs with the site seekingalpha.com. The market cap is much higher for VTI, with $317.62 billion, and there is also a much higher liquidity for the ETF, with 2.81 million shares exchanged daily, corresponding to $621 million, while ITOT and SCHB are only $95 million and $34 million, respectively. The other criteria holding, expense, and dividends are similar between all 3 ETFs. Hence, I think that VTI represents a much lower risk ETF. Let's now compare ETFs tracking the global market. 1. The Vanguard FTSE All World ex-US ETF, with the ticker symbol VEU. This ETF is managed by Vanguard and aims to track the performance of the FTSE All World ex-US Index. The index includes large and mid-cap stocks from both developed and emerging markets, excluding the United States. VEU can be a useful tool for building a well-rounded and internationally diversified investment portfolio. 2. The Vanguard Total World Stock ETF, with the ticker VT. This ETF is also issued by Vanguard and aims to track the performance of the CRSP U.S. Total Market Index, which includes both U.S. and international stocks. It provides investors with exposure to a broad and diversified portfolio of global stocks. 3. The iShares Core MSCI EAFE ETF, with ticker symbol IEFA. The issuer is BlackRock, and it seeks to track the MSCI EAFE IMI Index, composed of large and mid-capitalization developed market equities, excluding the US and Canada, but including Europe, Australia, and the Far East. 4. The Schwab ETF SCHF, which stands for Charles Schwab International Equity ETF. It is an ETF offered by Charles Schwab tracking the performance of the FTSE Developed ex-US Index. The index includes large and mid-cap stocks from developed countries outside the United States. Let's first analyze a graph comparing the performance of the three ETFs excluding the US market: VEU, IEFA, and SCHF in the last 10 years. If you had invested $10,000 in 2013 and reinvested the dividends, you would now have about $17,000 with SCHF, $16,000 with VEU, and $17,700 with IEFA. This corresponds to an average annual growth of about 5.16%, 4.55%, and 5.51% respectively. The max drawdown in two cases is about minus 27% and minus 28% for IEFA. If you remember the previous analysis, for the US total market, the average annual growth was around 13%, while the max drawdown was in the same range as those ones. Hence, let's compare now VT and VEU, which respectively include and exclude the US market. There is a huge difference of performance of these two ETFs, with an average annual growth of about 8.99% for VT, which includes the US market, and only 4.55% for VEU, which excludes it. About half the performance with a max drawdown in the same range, minus 25% versus minus 27%. Let's now compare the other criteria for all four ETFs. The number of holdings is similar for VEU and IEFA, around 3,000 companies, while it is of about 1,500 for SCHF and 9,600 for VT. The expenses and dividends are within the same range for all four. The market cap is about $30 billion for VEU, VT, and SCHF, and $98 billion, about 3 times more for IEFA. Similarly, the liquidity is around $100 million for VEU, VT, and SCHF, and $442 million, about 4 times more for IEFA. Hence, I think that IEFA is clearly the best if the US market is excluded, with higher market cap, higher liquidity, and higher performance. But as we have seen before, the performance is much higher when the US market is included in the ETF with VT. The choice of including or not the US market depends on you and your strategy. We will now compare the ETFs which track the S&P 500 index, which is the stock market index tracking the stock performance of 500 of the largest companies listed on the stock exchanges in the United States. We will analyze 1. The Vanguard S&P 500 ETF with ticker VOO is a popular exchange-traded fund that is proposed by Vanguard. 2. The iShares Core S&P 500 ETF, which trades under the ticker symbol IVV. It is issued by BlackRock. 3. The SPDR S&P 500 ETF Trust, with the ticker SPY. The issuer of the SPY ETF is State Street Global Advisors. SPY is structured as a unit investment trust, UIT. It holds the actual stocks in the S&P 500 in the same proportions as the index. Let's first assess the performance of these ETFs. As could be expected, all three graphs are overlapping and performance over the last 10 years are similar, with an average annual growth of about 13% and a max drawdown of about minus 23%. Hence, we have to examine the other criteria to check if there is any difference. SPY shows a higher market cap with above $400 billion, while the other two are about $300 billion. Similarly, the liquidity is also much higher with $32 billion exchanged daily for SPY, while VOO and IVV are only around $1.5 billion. The other criteria are similar, except for the expense ratio, which is 0.09% for SPY and 0.03% for the other two, 1/3. This is rather high. Hence, I would rather recommend VOO, which shows the best dividend yield and growth rate of the other two. You might be interested in living from your investment, and therefore from an income-oriented portfolio. Let's now see ETFs which have been designed mostly to pay high dividend rates. We will analyze 1. The Vanguard High Dividend Yield ETF, with the ticker VYM. It is offered by Vanguard and aims to track the performance of the FTSE High Dividend Yield Index. This index includes a broad range of large-cap and mid-cap U.S. stocks, primarily focusing on those with above-average dividend yields. 2. The iShares Select Dividend ETF, or DVY, issued by BlackRock. The ETF tracks the performance of the Dow Jones U.S. Select Dividend Index, which is composed of high dividend-yielding U.S. equities. Historically, this ETF has had significant allocations to sectors like utilities, financials, and industrials, among others. However, this can change over time. 3. The Schwab U.S. Dividend Equity ETF, with the ticker symbol SCHD, which is managed by Charles Schwab. This ETF is designed to track the performance of the Dow Jones U.S. Dividend 100 Index, which includes high dividend-yielding U.S. stocks. If we first compare the performance of these ETFs over the past 10 years, SCHD is clearly above the other two with an average annual growth of almost 13%, while the other two are about 10% and 11%. The max drawdown of SCHD is about minus 22%, lower than the other two. Regarding the other criteria, the market cap of SCHD is similar to that of VYM, with about $49 billion, with about 1/4 of the number of holdings, 100 versus 400, a much higher dividend growth rate over the last 5 years, more than double, and also higher liquidity with about double volume of exchange shares daily, 2.69 million. Hence, the conclusion here is easy. SCHD is clearly the winner. The ETFs analyzed so far were composed of stocks. Let's now see ETFs composed of bonds. Before we dive into this, it is important to note several points. First, what are bonds? Bonds are financial instruments that represent a form of debt. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments, the coupon, and the return of the bond's face value, also known as its principal, at a specified future date, known as the maturity date. Bonds are commonly used by governments, municipalities, corporations, and other entities to raise capital for various purposes. Bonds can be bought and sold in the secondary market before their maturity date. The market price of a bond may be different from its face value and is influenced by factors such as changes in interest rates, credit quality, and market demand. Some bonds are callable, meaning the issuer has the option to repay the bond before its maturity date. This feature can affect the bond's price and potential returns. Bonds are considered less risky than stocks, as they provide a more predictable stream of income based on regular interest payments at fixed intervals, which are predetermined at the time of purchase. However, they come with their own set of risks, primarily related to interest rate changes and credit risk. The risk that the issuer of the bond may default on its payments. Interest rate increases can lead to a decrease in the value of existing bonds, potentially impacting their resale value. Stocks, on the other hand, offer the potential for capital appreciation over the long term, but they also carry higher market volatility and uncertainty. In this part, we will assess various bond-based ETFs. 1. The Vanguard Total Bond Market Index, with the ticker BND offered by Vanguard. The BND ETF seeks to track the performance of the Bloomberg Barclays U.S. Aggregate Float-Adjusted Index, which includes a wide range of U.S. government, corporate, and mortgage-backed bonds. 2. The iShares 20-plus year Treasury Bond ETF, or TLT. This ETF tracks the performance of the ICE U.S. Treasury 20-plus year bond index. This index consists of U.S. Treasury bonds with maturities greater than 20 years, long-term, and is managed by BlackRock. These bonds are usually considered to be among the safest investments available because they are backed by the U.S. government. 3. The Schwab Intermediate Term U.S. Treasury ETF, with ticker SCHR. This ETF is offered by Charles Schwab and is designed to track the performance of the Bloomberg Barclays U.S. Treasury 3 to 10 year bond index, It provides investors with exposure to U.S. Treasury bonds with maturities ranging from 3 to 10 years. Let's compare the performance of the three ETFs over the last 10 years. As you can see, there is a huge volatility of the TLT ETF and an average annual growth of below or around 1%, which is really low compared to stock-based ETFs analyzed before, and the max drawdown is minus 41%. The best choice is clearly BND, with the highest market cap, almost $95 billion, the highest performance, although very low, the highest diversification, with almost 18,000 holdings. As you might have understood, I am not a fan of bond-based ETFs. However, it's essential to consider your overall investment goals and risk tolerance, and a well-diversified portfolio may include a mix of both asset classes to achieve a balanced investment strategy and cover all market conditions. Another way to potentially diversify your portfolio without directly purchasing and managing physical real estate properties is to buy an ETF composed of real estate assets. So let's explore the following ETFs. 1. The Vanguard Real Estate ETF, or VNQ. This ETF is managed by Vanguard Group and is designed to track the performance of the MSCI US Investable Market Real Estate 2550 Index. The ETF primarily invests in real estate investment trusts, REITs, which are companies that own or finance income-producing real estate across various sectors, such as residential, commercial, and industrial properties. VNQ typically pays dividends to its investors, making it attractive if you are an income-oriented investor. 2. The iShares US Real Estate ETF with the ticker IYR. This ETF is designed to track the performance of the Dow Jones US Real Estate Capped Index. It allows you to gain exposure to a diversified portfolio of US real estate assets, including real estate investment trusts and other real estate-related companies. 3. The Schwab US REIT ETF, with the ticker symbol SCHH. It is managed by Charles Schwab Investment Management. It tracks the performance of the Dow Jones Equity US All REIT Capped Index, which gauges the performance of publicly traded real estate investment trusts, REITs, in the United States. The ETF's portfolio would typically include holdings from various sectors such as residential, retail, office, industrial, and more. The performance of these ETFs is subject to the risks associated with real estate, such as changes in property values, interest rates, and market demand. Let's first examine and compare the performance of these ETFs over the last 10 years. If you had invested $10,000 in 2013 and reinvested the dividends, you would now have roughly $19,000 with both VNQ and IYR, and only about $16,500 with SCHH. This represents an average annual growth of about 6% for the first two ETFs and 4.8% for the third one, with a max drawdown of minus 29% for the VNQ and IYR and minus 30% for SCHH. Hence, VNQ seems to be the best. This is confirmed by the other criteria we discussed. VNQ appears to have the highest market cap with almost $32 billion, the highest dividend yield with 4.66%, while the other two are only slightly above 3%, and the second highest liquidity with 4.39 million shares exchanged daily, corresponding to $356 million. Hence, the winner is clearly VNQ. Now, to give an overview of our conclusions, we will compare the Podium-top ETF of each class we studied. These are VTI for total US market, IEFA for global market excluding US, VOO for S&P 500 tracking, SCHD for high dividend paying ETFs, BND for bonds ETF, and VNQ for real estate. Here is the performance graph comparison of the performance of these ETFs. The three ETFs based on US stocks, VTI, VOO, and SCHD, show the highest performance of about 13%, with slightly better results for VOO and similar max drawdown data for all three, slightly above 20%. Then come the global and real estate ETFs, IEFA and VNQ, with around 6% average annual growth, slightly better for VNQ, but with max drawdowns higher than those of the US market ETFs, about 29%, despite a lower performance. And then the bond ETF BND with only about 1% average annual growth, less than inflation with a max drawdown of 17%. However, if one considers the other criteria, especially dividend yield and expense ratio, the ranking is very different. The highest dividends are paid by VNQ, real estate, with 4.66%, but also the highest expense ratio of 0.12%. Then comes SCHD with 3.53%. This seems logical as it is the dividend-designed ETF. The expense ratio is 0.06%, half that of VNQ for only 1.3 times lower dividends. The third on the dividend podium is BND, the bond ETF with 2.99% and only 0.03% expense ratio, a fourth of VNQ for 1.5 times lower dividends. Then comes IEFA, the global market ETF with 2.44% dividend yield and a relatively high expense ratio of 0.07%. And only then comes VTI and VOO, the US market ETFs, which were the winners of the performance criteria. All these ETFs have high market cap and high liquidity, so there shouldn't be any concerns on those aspects. Hence, the choice really depends on you, what you expect most, dividends or long-term performance, and if you prefer to invest only on the US stock market or diversify more with real estate, bonds, or global stock market. But whichever way, I highly recommend investing in ETFs. If you want an even better performance with a lower drawdown, you can also copy my portfolio. Let's compare the results of my portfolio with the two best performing ETFs we just analyzed, VTI and VOO, since 2016. The two ETFs have a performance of about 17% per year, while my portfolio shows an average annual growth rate of more than 22%. But maybe you think, yes, okay, but this is with very high volatility. Nope. The max drawdown of the two ETFs is around minus 20%, while that of my portfolio is around minus 15% only, almost 5% less than those of the two ETFs. And this is without taking into account my secret booster. If we now compare the performance with that secret booster since 2016, the average annual growth is almost 30%, with only a slightly higher drawdown, minus 15.74% instead of minus 15.39% without that booster. So it's entirely up to you and your strategy. You can either buy ETFs and spend time only when you buy them, or dedicate a few minutes per month to your investments, as my portfolio is updated every month and have a better performance. But take good care of your money. If you do nothing, you lose daily, just because of inflation. If you liked this video, feel free to watch this one, which is complimentary. Thanks for watching. Goodbye.